Scott, it's been an eventful week on the headlines front coming out of the White House vis-a-vis the economy. Do you feel as though these latest developments position the markets in the coming months to be better off, worse off, or just about the same?
Well, good morning, Dom. Look, I think it's probably just about the same. Nominating somebody this close to Trump is sort of the Trump playbook in terms of what we should expect from the Fed. He's going to be a reliably dovish vote. He may even dissent for 50 if he's nominated in time for, or confirmed in time, sorry, for the upcoming September meeting. That's going to make it increasingly challenging for Powell to continue to hold the line on keeping rates where they are. It probably does move the needle a little bit on the dovish side, but we don't see this as a really massive move.
All right, Scott, what's your baseline scenario? What's your base case for how interest rates play out for the balance of the year? Are you in the 2 camp, 50 basis points in total? How exactly do your assumptions change, if any, if they change at all, given what's happening right now?
Well, we think we thought for quite some time now, actually, Dom, that 2 is probably about the right number. It's a little bit more of a risk management exercise for the Fed. They do think that they're slightly restrictive. We do have a labor market that's very clearly softening. It's not really soft, but it's definitely softening. And inflation is relatively contained, and we got really good productivity numbers out yesterday that continues to put downward pressure on wages. So the entire picture is one of that. The labor market, the labor market is kind of starting to win in terms of being the thing that's important to the Fed. And if they think they're slightly restrictive and the labor market is starting to weaken some, it makes sense for them to kind of try to get back towards neutral with not necessarily quickly, but definitely over the next 6 months. And so we do think rates overall are about where they need to be right now. This should not affect, by the way, the 10-year. The 10-year around 4.25 to 4.5 is probably about the right level. That means mortgage rates are about where they're going to be. So overall, we don't see this as a massive move, but it does probably help solidify that we are going to get a couple more cuts coming by the end of the year.
All right. So, Scott, if things are just about where they should be, that implies that you can take those variables off the board. What does that now mean for the investing picture along the side of equities as we look at whether the markets are fully or underpriced at these levels?
Don, I think it means that we can really start looking at the things that do end up moving stocks over the medium and longer term, and that's one, that's earnings, and that's 2, that's sort of the macro economy. And on the earnings front, we're getting through with really what was a pretty darn good earnings season. You have EPS growth about 12%. That's better than historical averages. We had sales growth that were beating estimates. So overall, this is an economy that's continuing to chug along, driven by AI capex, which is a massive. You can think about AI capex. Really, it's kind of like a private sector stimulus program. I mean, it's getting to be that big, and the provisions inside the big beautiful bill with respect to deductibility of basically of infrastructure spending is good. Should only drive that forward more. And so overall, we see this as a market to buy. The next couple of weeks could be a little bit choppy just as we get through sort of some air pockets that we think we're in right now. But really, by the end of the year, we feel pretty confident that we're going to be higher.
All right, and Scott, really quickly before we let you go, your best pick for the rest of the year.
We really like infrastructure, actually, Dom. We do think it plays into all the relevant themes in terms of AI capex spend and the Trump administration's insistence that they want to get manufacturing bigger in the United States, and so that is our best pick for the rest of this year.